Greetings, Doom fans, and welcome to another edition of the Frostbite Falls Daily Rant, here on the Doomstead Diner. It's been a hectic couple of weeks here, with the Greeks imploding and the Chinese stock market getting sucked down a black hole, and the price of WTI and Brent crude getting flushed down the toilet once again. I am, however, burned out on rehashing the Greek clusterfuck in another rant this week. We need a new topic to rant on. So, instead of going ballistic on the latest in the Greek kabuki souvlaki, let's get back to that underpinning clusterfuck, the price of black gold, oil that is, Texas tea. While quite obviously the financial problems cropping up in Eurotrashland and China both hold the potential for contagion across all markets and currencies, there is no more critical leading indicator to watch than the price of oil, which has been positively hammered over the last week or so. From Wolf Richter, on June 24, reality did start to hit. From that day's high of $61.50 a barrel, it has been one nasty ride. Currently, WTI trades for $52.67 a barrel, after a 7.5% plunge since Thursday. Friday had only limited trading, to settle at the lowest level since April 13, down 14.4% since June 24. Now, here's the deal. At the $60 plus range that oil climbed back up to after its nasty crash in December and January, which took it down to as low as $47 a barrel, many of the companies in the oil extraction and fracking biz began the process of shutting down rigs and laying off workers in order to shed costs while attempting to ride out the storm and wait for prices to rebound. Through this period as well, most of these frackers were hedged against an oil price drop in the futures market, with locked-in contracts allowing them to ride out brief periods of low prices. However, as more time goes by, more of these hedges run out, and the frackers are forced to sell at whatever the market price is, which for many rigs, except those in the sweet spots, comes in at a loss. So, the rigs not already producing are shut in, and the workers servicing those rigs are laid off, cutting costs. This has been an ongoing process since January. One class of overhead costs cannot be cut, though, and that is the debt servicing of the massive amount of debt these companies racked up while prices were high and investors were trampling over each other, offering gobs of debt in the junk bond market and even in the investment grade market for these companies to buy equipment, hire staff, etc., to go and capitalize on the high energy prices while they existed. The theory here, of course, was that not only would these high energy prices persist, they would in fact go ever higher, and everybody in the energy extraction biz and the banking biz would get even richer than they already are. The theory, like with real estate, is that the prices will never go down. There is a small problem with this theory, however. The prices can only continue to rise for so long as the end consumer also has access to credit to buy the stuff, whether it is McMansions or tankfuls of gasoline for the SUV. How does the consumer mainly get access to that credit? Mainly in the functioning years through the wages paid to him for jobs he has in the industrial society. As these jobs disappear or drop to lower real wages, the amount of credit the consumer has to burn the oil becomes less all the time. For a while, this was masked by offering to the consumer himself credit directly in the form of HELOC second mortgages and credit card debt. In order to maintain the industrial lifestyle while their wages decreased in real terms, many people racked up enormous debts, far past what they could actually service. Not a whole lot different than what occurred in Greece on the nation-state level, just it occurred on a more distributed individual basis to everyone, not just in the FSFA, but in Europe too. And really everywhere people were continuing to try to live the industrial lifestyle for as long as they possibly could. Few people willingly power down, move out of their McMansions to live in an RV, or even if they have enough saved money, move to the boonies to set up a doomstead and try subsistent living, even just partially. It takes a skill set most people do not have. It's costly to set up, and even if well done, you still have costs like property tax, and you still need inputs from the industrial society as well in terms of tools and equipment, and probably some foods you would like in your daily diet but can't grow on your property, like maybe oranges or avocados or bananas, etc. At a certain point in 2008, it became clear that many people could not pay up on the subprime mortgages, which meant also that real estate prices began to drop. So even if a bank foreclosed on a mortgage, they couldn't resell the property at a profit, or even break even. Huge numbers of McMansions went into the shadow inventory and remain there to this day. The bailout of AIG and the endless quantitative easing since 2008 has been an effort to paper over that problem. In the aftermath of that crash, the price of oil dropped from its all-time highs above $140 a barrel to around $30 a barrel. A full-blown recession was underway, which the powers that be were only able to halt through quantitative easing and massive accounting fraud over these last few years, making available cheap credit at 0 interest rate percent to just about any bozo company that could fog a mirror. Besides the frackers, cheap and easy funny money went out to IPOs to idiotic companies like Facepalm, Poupon, Uber Dopes, and Alipoopoo. Gobs of funny money poured into numerous shady Chinese enterprises and development projects of ghost cities that remain empty to this day. This massive bubble blowing on a global scale kept the industrial economy somewhat functional for the last 8 years. But of course, all bubbles do pop in the end. And now this one is in the process of doing said popping. Why? Well, because although vast amounts of funny money in terms of credit was offered up to industries and corporations, credit available to the consumer continued to contract throughout the time period. More good-paying jobs were lost in the fascist states of America economy, replaced by often, at best, part-time, lower-wage jobs in the service industries, but equally often by millions of people simply dropping out of the labor force. In Southern Europe, the situation was even worse, with 50% plus youth unemployment rates in Greece, Spain, and Portugal, with even France not doing a whole lot better than that. At this point, not only do people stop paying their mortgage, they stop driving around their cars willy-nilly, even if they still own one. So, incrementally, almost unnoticeably, the demand for energy has been dropping, and it's not just in the area of automotive traffic. As more Chinese factories go under because consumers aren't buying their products in ever greater quantities, these consumers of the energy also stop using it, or at least significantly reduce how much they are using. It doesn't take a whole lot of demand destruction on a global level to begin producing a glut of oil. 3 to 5% less demand than is projected over an extended period will begin filling up all the storage facilities and tankers which can hold large quantities of oil for refinement and sale later on. When all storage facilities are full, all oil has to be sold at whatever the market will bear at that point. Even before that, really, because as all storage facilities start filling up, the owners of those tanks and ships start charging higher prices for the oil storage, driving up the cost to the producer or speculator even before all the room has run out for oil storage. The result here, of course, is that just like everyone's speculating that home prices could never fall, you have a whole class of supposedly savvy investors who borrowed a ton of money at low interest rates here in the FSA and dropped this money in Chinese stocks, real estate, etc., looking for high returns on the investment. This is the carry trade, of course. The Chinese can no more grow infinitely in a finite world than anyone else can. And at some point, the outrageous bubble these folks blew up with hot money had to pop. And pop it has now, with a vengeance. The Chinese market has lost around $3 trillion in market cap over the course of just a couple of weeks. And today, on open, the Chinese suspended trading in over half the stocks listed on the Shanghai bourse. It's even worse on smaller exchanges that list more risky stocks than the so-called blue-chip stocks listed in the Shanghai Composite Index. If you want to look for a reason why the price of oil has collapsed, you need look no further than what is occurring in China. It dwarfs what is going on in Greece by an order of magnitude, probably 2 orders of magnitude, at least until the Greek flu becomes contagious throughout the whole Eurozone. Chinese investors are going broke by the boatload here, which means more factories closing down, more laid-off Chinese ex-rice paddy workers, and fewer Chinese buying gas at the pump as a result. All of these phenomena feed off each other in a series of positive feedback loops, and it all stems from the ever-increasing cost of extracting energy and the ever-decreasing amount of credit available to the end consumer to buy the products of industrialization. To an extent, containment is possible with a small country like Greece, at least for a while. Such containment is not possible with China. Between the oil price crash and the Chinese market crash, you have a perfect storm. The shit has hit the fan. And that's all the doom. This time, until next time, here on the Doomstead Diner.